All right, well, I do want to welcome you all. It is 9 o'clock and it is time to start today's ASNA Edge October marketing meeting. I want to welcome you and thank you for joining us today. It is a beautiful day in Illinois. We have a lot going on today. It is still harvest and we have a lot of people in the fields. So if you are, let us know and send us those pictures if you're in the field. We do have our ASNA Edge virtual crop tour harvest edition that will be coming out the end of this month. And we are still gathering photos for that. And that is really turning out to be a beautiful, beautiful publication right now. So please send us those pictures just with a brief description of what you're harvesting and what you're looking at right now, where the location. I'll put that email in the link or in our chat box so that you can know where to send those to. It's just, we're looking at some really, really neat things coming in that edition. It will be in our daily email, so make sure you get that sent to us here by October 24th so that we can get those included. We again want to thank you. We have our team with us today, as well as a special guest that you can see on the screen here. So we have Sterling Smith, who is our Director of Ag Research. We have Mike Toohill, who is our Corporate Agronomist. And we have a special guest today, Alexis Maxwell. She is the Research Director for Bloomberg's Green Markets. Her previous positions include market research and sales roles at fertilizer producers SABIC and CF Industries, as well as development roles at satellite imagery analysis startup Landworth, where she focused on agriculture production and economic market analysis. So without any further ado, I'm going to go ahead and pass the ball on over to Sterling because he has all sorts of information for you today, some good news, some interesting news, and he's just going to get us kicked off all right today. If you do have any questions, though, please put those in that chat box, and we will get those answered for you as soon as we can.
And thank you, Christy. And today, I don't have all bad news. I actually have a couple of pieces of good news, and we're going to go ahead and start with that right now. And let's see here, we can share our screen here. And you should be seeing a screen that shows the price of soybeans. Is that correct? Is that what everyone's seeing? Yeah. Very good. As you can see, soybeans are doing noticeably better today. We're up 19 cents and chasing up towards that $14 level. And there's a couple of things that I'd like to point out. The first thing is chart pattern right here over the last 3 days. If you can see this, this is a bit of a pattern that is kind of bullish, and we took off from a new low, had a nice reversal, and we moved higher. If we can trade higher tomorrow, we may see soybean prices improve after a period of, well, a bit weak and a lot of sideways. The grain markets have been very quiet of late, and you know, they're starting to get a heavy feel in some places. But the driver behind this good news is this next chart I'm going to show you. This is a chart of soybean export sales. And as you can see, particularly really since the end of August, we have not done very well. In fact, we have done rather poorly, and there were a lot of concerns. We've seen, you know, the rising dollar and everything else putting pressure. But today we had a pretty good number. A little over 2 million metric tons sold in all old crop. There weren't any new crop sales yet, which is still a little bit of a problem. But if this is a good sign of a turnaround, and if we can keep it going, we've seen more flash sales and things of that sort. So if this can continue, this should allow the USDA maybe to put some export sales back into that balance sheet, and maybe we'll see supplies remain a little bit snug, and that should be good and supportive for prices. So that's the good news. And as you can see, the soybeans, their strength is helping out the corn market. Now, I'm not worried that we're going to see particularly a crash in the corn market where we're going to get really beat up on any given day. But I am concerned that if we don't keep export sales in line, if we don't see a pickup, the export sales for corn weren't very good today, but at least we got a good number for the soybeans. So I'm a little worried that we could see some price erosion in the corn here simply because we have a very large fund position. And if those guys start to get a little bit tired and a little bit bored with things, we could see some problems develop and the corn market could start to erode a little bit. Thing we really need to be thinking about now, we're at harvest. What we have made is what we made, and now it's getting it out and getting it moved. And I'm sure Mike's going to talk about the river situation, which if you look at today's drought monitor, if you look at the 4-week change, there's a disturbing increase in drought right at the confluence of the Mississippi and Ohio rivers. So that's going to be a problem. Hopefully we get some rain and we can make things move. We're supposed to start seeing precipitation pick up a little bit. But again, I don't know if we're going to see any drought busters in that precipitation. It has to happen. So a little worried about corn here. I don't think we're going to drop back, trading down into the fives, but we could probably challenge that 650 level relatively easily. Moving on to the wheat market. The wheat market had been doing pretty well, and we had started, as you can see right here, we had had a pretty good little rally going on. But here, for you chartists, this is called a tweezer pattern, where we go up, turn around, and make a U-turn and come right back down the next day. This is a reasonably reliable pattern, and it worked very well here. We put in the top, and now we're beginning to leak lower. There is a growing story that we are going to have trouble with the Australian wheat crop, and particularly with the quality of it. So if you're a holder of quality wheat, you are always in better shape there. But generally speaking, the wheat market has adjusted everything that's going on in the Ukraine, and it's also a very hand-to-mouth situation. Funds are not willing to be too aggressive in here, coming in here and buying and supporting it. Kansas City wheat in particular struggled in here. Let's put up a chart of that here real quick. There was a particularly noticeable level with the Kansas City wheat on the December futures. And when we look at that, we tried to play above $10, and right here, we made a nice little high, got over $10. And again, the little tweezer pattern came in and took us back and took basically $1 out of the market in the last 7 days. So there's not a lot of good aggressive buying in here from the speculative side to help push prices up. So unless we get some sort of new bullish input, which could happen at any moment, the wheat market continues to tread water at best. And there's nothing in here really right now to drive things higher. So with the grain markets being a little bit dull, we're going to talk about some other things here too today. And we're going to talk about a new worry for food inflation. There's bird flu in the United States. In fact, I picked up a story from Reuters here a couple of days ago that we're near a record loss for birds. And right now we're looking at turkey prices being 73% higher than they were last year. So this is going to be a bit of a jolt for consumers, and we're going to see a bit of a change in consumer behavior. One other thing, cattle supplies have been slowly getting tighter, and I do a daily podcast covering the cattle and livestock markets. If you're interested, certainly feel free to sign up for that, along with our daily podcasts going over all the markets. Quick and easy. I try to keep it no more than 5 minutes. So it's to the point, but trying to get the most important and interesting things to you in a nice, easy to use, compact way. But looking at the cattle prices here, we've moved from 146 to 150. And that in and of itself is not that big of a deal, but we are starting to see cutout values, meaning what retailers are willing to pay for beef. Those had cratered pretty much in September and October, and we're starting to see those move up noticeably. And that in turn means that the packers can pay more for cattle as supplies tighten. And we have not seen a cash trade above 150 until yesterday. And we're starting to see dressed values and cutout values improve meaningfully. Now, when we move on to their squealing friends, the hogs here, we've had quite the ride in the hog market. Funds got inexplicably long coming into the fall, which is not really normal because usually we see a bump up in hog supplies, particularly through the month of October and into November. And they got caught long and they got flushed out of the market. And we had a big, wild, crazy day, but they've come right back And we're seeing things like belly values had dropped down to $1.10 a pound. We saw those move up. They're back up close to 140. So that's recovery. And part of that is if we start to see chicken prices move up, pork is the other white meat. And in turn, people are going to be throwing different things in that shopping cart a little bit. So I think when we start talking about inflation, food inflation, the next culprit is going to be in the protein, in meat and chicken. And this is going to be something that's going to keep that inflation monster a little bit fed. And moving on now to the crude oil, we're going to take a look here at crude oil. And you can see crude prices, generally speaking, we've done better. We made our peak here at the invasion, and we worked ourselves lower here until OPEC decided to cut production and prices moved back up, and we spiked up and got north of $90. We started coming back down again, and I don't want to get political here, but there was a speech yesterday from the administration chastising the oil companies and saying that we're going to take more oil out of the Strategic Petroleum Reserve in order to alleviate prices. Well, that happened yesterday, and we can see what the market did. The market turned around. And again, when we see a reversal like this and we make a little bit of a pattern like this, that tends to be bullish. Now, OPEC has another meeting coming up in November. I think it's on November 4th. And it is entirely conceivable. OPEC wants to keep energy prices stout, meaning north of $80. So are they going to be willing to come in here and cut production again? It is entirely conceivable that yes, they will come in and cut production. And speaking of the Strategic Petroleum Reserve, we're going to pull up a little. This is a very interesting chart. We're going to go all the way back in time, back to when Mike and I were in high school. Way back in time. This up a little bit. As you can see, this is a chart that starts way back in 1980. And here's where we are. We're all the way back to the same levels we were in the early 1980s. And you can see the cliff that we have fallen off of. So this reserve is getting tighter and tighter. And this is going to eventually, well, I mean, theoretically, eventually we could run out. So at some point, the bullets from this gun are going to be exhausted. So what OPEC decides to do with things is going to play a factor in assuming they're going to cut production, which seems like, guide the future by the past. And they had no problem cutting them a month ago. And if prices are not back up, I don't see anything getting in their way. Now, the other problem that affects us right on the farm directly here is diesel fuel. I'm going to put up a chart of diesel here. Let me get a little clearer chart. As you can see, the price of diesel, and it doesn't look that much like the crude oil chart. It's remained quite stout, and we're back higher again today. Airlines are reporting travel has changed. They're actually making money, which for an airline is a pretty good trick to begin with. But load levels have changed, and how people are flying has changed, but more people are, in fact, flying. And when they crack a barrel of crude oil, jet fuel and diesel fuel are very close in that cracking process. So we're seeing supplies tighten. Along with this, in the Northeast, the storage capacity for diesel fuel has been diminished over the last 5 to 7 years. And what they were doing is they were importing partially refined oil into Philadelphia, and there's a big refinery there that was producing most of the diesel for the Northeast. The problem is that where that partially refined oil was coming from Russia. So diesel supplies on the East Coast may become particularly tight, and this may create a squeeze. Along with this, starting in December, the EU is going to be banning crude oil imports from Russia, and that's going to take a lot of oil back off the market. It may find new homes in places like China and something like that, and it may not affect the global market. However, if they can't find a home for that crude oil, that again will end up seeing supplies tighten as Western Europe will want to be buying it from the Middle East or maybe even from the United States. It is possible that the administration could put in an export ban on diesel fuel. That could happen. That's something so far they've been unwilling to do, but that's entirely possible. Another thing that they did this in the 70s, it was called a windfall profits tax. They levied that on the oil companies. And that in turn, when you start adding taxation, that's going to de incentivize production. So I'd like to think that we're kind of past the worst bits of the energy market, but we have an entirely new game going on. As far as pump prices, I'll punch those up here real quick. Pump prices, well, again, we had done pretty well. We were 340 on the futures. We took, basically $1.20 off of them, down by about a third, in line with what crude oil went down. But if we look at the behavior of the gasoline market here, again, we're seeing this, maybe we're making a bottom here. And if we get back north of 280, there's a pretty good shot that we'll challenge somewhere in the threes. So it is entirely conceivable. I mean, gasoline prices are up noticeably over the last 3 days, and we're up another 5-6 cents a gallon. So there may be some unpleasant things at the pump. So with all this bad news, some of it not so good news, I have some good news for you. In my previous life, not only did I do grains and energies and fixed income and everything like that, I also did analysis on the coffee, sugar, and cocoa market. And this is the chart of a coffee market going back. And normally we see coffee trading at about 80 cents a pound. We did make a pretty serious peak up here at about $2.50 a pound. We've come back nicely down to $1.91 a pound. So with improved weather in Brazil, which while that may be a problem for the grain markets, and we'll see just exactly how that develops, that is good for the coffee market. So at the very least, when you go to the gas station, you fill up your car, the price of coffee won't be going up. And we'll take a quick look here. We'll look at interest rates here because, we have to give some good news and we have to give some bad news. This is the rate on the 10-year. We made a new high again today at 417. And as you can see, at the start of the year, we were trading at about 1.5%. Now, if any of you need operating lines of credit or need a mortgage, if you were around with us in January and February, I implored everyone to do it then. If you look at where a mortgage is right now, the 30-year fixed is at 7.22%.
Wow.
It started the year at 3%. So my thinking on this, and this will probably change 3 times before lunch. I think the 10-year goes to 4.5%. Mortgage rates will get to about 8%. I think at that point the Fed may relax a little bit. So that may at least stop the erosion of conditions, but it's going to take some negative prints in the inflation numbers before the Fed really relents on this, and that might be a little bit away. As far as the equity markets, we had a big wild day on the CPI day. Interest rates are back up to the same level they are when the market was trading here. So far, we're holding out and we're holding up okay, but we are, at any given time, one bit of bad news away from problems setting back in. The market is still very unstable. We may be able to make a little bit of an intermediate bottom like we made here, but as far as the terminal low goes, I don't think that has happened yet. And with that news of nervousness, here is some good news. This is the price of natural gas. It has come off noticeably. We were trading up north of 10 in August. We're now down, trading at least below 6. We're still well above the same level that we were at last year, but at least the market is going the right way. The Europeans have put together a package to at least get their situation under control, and European gas prices have dropped meaningfully, and that's taken a lot of pressure off of this. So we'll see how the weather goes, but at least this market, for the time being, it's gas and can get extremely volatile, but at least for the time being, things are looking a little bit better. And with that, Alexis, are
All
you ready to
right,
tell us all about fertilizer?
I am. Let me just share my screen here
Let me
first.
stop sharing. There we go.
Okay. A bunch of slides here with a lot of data about prices and green markets. And let me just start the presentation and we'll be all set. Oops. All right. So my name's Alexis. I'm the research director with Green Markets. We are a fertilizer price publication. That means that we are serving people who participate in fertilizer markets weekly, collect prices for the wholesale market. That's really the transaction between the producer and the ag retailer. We have about 450 different prices, also some retail pricing as well. If you want more access to fertilizer pricing, you can always go to fertilizerpricing.com and learn more about us. Okay, of that out of the way, onto the good news. Prices for fertilizers have softened remarkably since the second quarter. They've come off for nitrogen, potash, phosphate. But however, prices are above last year's level as when we were sitting around here in October contemplating what the fall run for fertilizer was going to look like. I'm going to go into some of the details on what's driving this this relief in pricing. I know that that's not really much of a release when if you look at our Green Markets North American Fertilizer Price Index, and it's come off 40% since the second quarter, but it's still near a record high. This index is a weighted average of phosphate, potash, and urea prices. So I've got a very busy slide that sort of kickstarts the conversation about fertilizer. This is probably something that if you get the slides after we're all done here and you want to know more about fertilizer markets, you can take a run through this. But this is an accounting of basically how did we get to ammonia prices at a record 1625 in the second quarter. You know, this story really started in 2020. Everyone went home for COVID. Ag prices relative to fertilizer prices were great. Fertilizer demand started to skyrocket. We added relatively little capacity to new fertilizer production in 2020 and 2021. You had a massive wave of shutdowns unexpectedly in the nitrogen market in 2021. You know, things like a winter storm in Texas, hurricanes in the Gulf Coast. And then as natural gas started to tighten, fertilizer prices responded. And then on the political side, in both China and Russia and Belarus, we had a combination of export bans, sanctions on trade, and export limits. So all of this to say that this whole fertilizer crunch that we're in right now, this is driven by a variety of supply side factors. And what that really means is it's going to take some time for demand to respond and for prices to fall. This isn't a scenario that I can just, fix in the next 3 to 6 months. So if we delve in a little bit deeper on what's happening, we've seen some relief here. So I mentioned sanctions as a big part of why fertilizer prices skyrocketed in the second quarter. That was sanctions on Russia. Russia's a really big player in the fertilizer market. They export all NPKs. They're one of the largest exporters. They're a low-cost producer, and we saw them step back from the market in a big way, primarily on the nitrogen side. And that's because they have an ammonia pipeline that manages about 20% of global ammonia trade. That been going around offering comfort letters to people involved in the trade of fertilizer, the folks on the banking side, the shipping side, the logistics, and the traders to allow them to get the financing and credit that they need to move Russian fertilizers. So we've seen Russia come back into the market, easing some of these supply shocks. And We're starting to see a little bit more Belarus potash coming into the market. Belarus was sanctioned by the EU and the US in the first half of this year. They're finding new outlets in Russia. And amidst all of these changes in the market over the past 2 quarters, what we're seeing is farmers are starting to pull back on fertilizer consumption. And why is that happening? Well, despite the fact that fertilizer prices have come off about 20 to 40% depending on the nutrient in the past quarter, if you look at the ratio of an index of fertilizer prices to an index of ag prices, and fertilizer is a very expensive nutrient. It remains near a record high on an affordability basis. So it's really no wonder that farmers are starting to pull back on fertilizer. They just can't afford it. And so we're starting to see that come through in trade. If we aggregate import numbers for most of the fertilizers, ammonia, phosphates, and potash, we see that imports of those major nutrients are all down year to date, with the exception of urea. And we're going to go into a little bit as to why that's happening, but the big picture is, demand is doing what it's supposed to when prices are high. It's starting to fall back. What we're starting to see too is a more normalization of trade. So in the second quarter, when the world started to sanction Russia, that really put Brazil into a pretty bad, tight spot, because Brazil does a lot of their fertilizer buying in the second quarter for application in the third and fourth quarter. And so you saw some really extreme spreads develop in the fertilizer markets as Brazil sought every available opportunity to purchase and import tons. I mean, at one point, the differential between MAP in the US and Brazil was over $300 for a commodity, and that's really extreme. The average spread there should be about $10. Saw the same thing happen for potash. And so what did we see all the producers of fertilizers do? Well, Brazil was a really attractive market. They sent a lot of fertilizer into Brazil, and now we're hearing reports that the warehouses and the distribution channels in Brazil are really full. In fact, we're actually seeing some traders start to take fertilizer from Brazil and ship it into the US because they're getting killed on the demurrage in the Brazilian market. So we're starting to normalize on fertilizer pricing as the market starts to heal and replenish the supply chain. And just as that's starting to happen, currency is starting to emerge as a really big issue for the fertilizer market. The US dollar has strengthened remarkably. Sterling, this really goes into, we talk about interest rates, and the Federal Reserve is really starting to tighten financial conditions. Well, that's making the dollar stronger relative to other currencies. I've got this graph here on the left, and that just ends up making fertilizer more expensive. So you've got sort of a double whammy for people outside the US who are looking to buy fertilizer. It's more expensive just on a per ton basis because it's traded in dollars, and then you strengthen the dollar and it makes it very difficult for farmers globally to get the cash and credit they need to trade and purchase fertilizers. I'm going to spend just a little bit of time. I think this is knowing the audience here. If we look at fertilizer prices, the spike that we've seen in fertilizer prices is not matched by the strength that we see in agriculture prices. There's a big differential there. And what that ends up translating into is a higher cost of production for corn. Looking at the crop that farmers are going to start to apply anhydrous for this fall for planting in spring of 2023. If you look at expectations from the USDA on what it's going to cost to make or to plant an acre of corn, we're looking at an expense of almost $400 per acre to plant corn next year, and that's really driven by higher fertilizer prices. If you look at what we're hearing from the USDA on other inputs like chemicals and seeds, those costs on that end have moved up, but not nearly the same way that we've seen fertilizer expense rise. So I'm going to talk about nitrogen. I'm going to go into that a little bit in detail, what's going on. I know that that's kind of front of the minds because the anhydrous run here is about to start in just a couple of weeks. And things to remember, why did we end up with ammonia setting a new record price of $16.25? Well, it was, as I mentioned earlier, Russia invaded Ukraine. We sanctioned Russia. We took a lot of nitrogen off the market. European natural gas prices were spiking basically for the past year, pushing the cost of production for ammonia up. So to make 1 ton of ammonia, it's pretty easy to do the economic math on it. It's 34 MMBTUs of natural gas will make 1 ton of ammonia. And that's contributed to the higher price of ammonia. The Chinese export policy, now that's on here because China is the marginal producer for nitrogen. When they are exporting nitrogen, prices are falling. When they're not exporting, prices tend to rise. And China enacted an export ban on nitrogen fertilizers last winter. The policy officially ended just this past May, and that supported higher prices. Now, we haven't heard a peep out of China officially on the status of this policy, but heading into the winter with continued tightness in the energy markets, I'm expecting that we're not going to see China return to the market in a really big way. Contributing to lower ammonia prices, ammonia at Tampa right now is just under $1,200 a metric ton. We've had some new capacity come online in the Middle East, some new plants in Saudi and Oman. But what's been really interesting about ammonia prices is that typically they're really well correlated to the price of natural gas in Europe. Looking at this chart here, prior to 2020, ammonia prices in Western Europe sort of ticked along with the price of natural gas. But that disconnected in the third quarter. We saw natural gas prices in the UK shoot upwards of almost $70 per MMBTU, which is nearly a $2,000 metric ton cost of ammonia production. But ammonia prices stayed at roughly between $1,100 to $1,200 a metric ton. So what's going on? Why did this price relationship break down? I mean, you saw a wave of ammonia production all in the news in the third quarter. We took about 11 million metric tons of ammonia production capacity out of the market. Well, what we've seen happen is that the market, what I'm going to do is I'm going to talk just briefly about the cost curve to explain why ammonia prices haven't gone up again to incentivize production when natural gas is like $60 or $70. And the fact of the matter is that, well, I have a cost curve up here. I know probably some of you folks might be listening to this. I'm not looking at your screen right now, so I'll just sort of walk you through this. But on this graph, we have on the x-axis all the available capacity to produce ammonia. We can make, if everybody in the world turned on their ammonia plants, we could make about 240 million metric tons of ammonia. But annual demand is only about 180 million metric tons. So not everybody in the market is going to be running and making money on an annual basis. That's what this cost curve is telling us. And European production is a high-cost producer. And so normally in times of high prices, you would expect them to shut down. And that's what we're seeing. And so the fact that ammonia prices are only about $1,200 in Europe today is a sign that the ammonia supply chain is sort of, I guess I would use the word healing. We have more supply in the system, and we're seeing producers we're seeing producers in Western Europe, what they're starting to do is they're buying ammonia from places like the US and Trinidad, and they're using that cheap ammonia to make their other fertilizer nitrogen products like UAN or CAN. Also, ammonia trade globally is slowing. Paying attention here, what's going on is the traded ammonia market's pretty small. Globally, it's only about 20 million metric tons, and considering that the total market is 180 million, that's a small component. But the global ammonia market is really dominated by Southeast Asia. You have South Korea, Japan, they're really big buyers of ammonia, and they use it for industrial production. And they're starting to pull back. Paying attention to China, China's also pulling back on their ammonia purchases. And what's happening there is as you have, the Chinese government is doing continued shutdowns to manage COVID, you're having industrial production in China shut down, so the import demand for ammonia isn't there. So Trade is slowing, and one factor to watch, I mentioned the pipeline that manages a lot of the ammonia trade that runs through Russia. That pipeline is still shut down. I want to end on the ammonia market to talk a little bit about the seasonality of ammonia, though. If you're thinking about making an ammonia purchase, when is the time to really do that? So what I have here is an average of ammonia prices over the past 5 years. There's a pretty strong pattern that emerges. Ammonia prices hit the low in July, and then they run up through the fertilizer year, hitting the high in the spring. Now, what's different about this year is that, once we're going to be watching the weather in Europe, what's length is going to ease the tightness in this market. Gosh, I'm going a little bit long here. I guess I have a lot to say about fertilizer.
You're doing fine.
Doing fine. Talk as much as you like.
Yeah, so we're seeing, so I mentioned, we have this pattern in ammonia pricing. We're seeing that repeat this year. We saw ammonia fall in July. It started to pick up again here at the Corn Belt wholesale level. It's almost $1,400 a short ton. What the market is signaling to farmers this year is, if we look at a application rate on the right-hand side, this here is just basically the expected corn price at harvest next year relative to the current ammonia price. And what's happening is in 2022, so that's the 2022 crop. So that would have been fall of last year. I work in a fertilizer year basis, so just remember that when you're looking at this isn't calendar year. But last year, the market was telling farmers to pull back. We had a big run up in ammonia prices, and corn prices hadn't kept pace yet. And pretty much, I think last fall, everybody knew that ammonia was pretty cheap in the fall and that it would only get more expensive in the first quarter. We had a big fall run for ammonia. But this year, with an increase in corn prices and relatively stable ammonia prices, the market is telling farmers to use a little bit more anhydrous in the fourth quarter. Now, one thing to watch that I really want to point out is that we're seeing a really abnormal spread emerge in the U.S. nitrogen market. If you look at ammonia and urea on a nitrogen basis, ammonia typically trades at about a 5-cent discount to urea in the Corn Belt. And, that's the reason why farmers use it pretty heavily in the fall. It's cheap. You can put a lot of it down and get yourself ready and set up for, save yourself some time in the spring when you've already got a lot of your nitrogen down in the ground. Well, this year, on a nitrogen basis, ammonia is trading actually I know the answer. Ammonia is trading 3 cents higher than urea, in a complete reversion of what you would normally expect with the spreads. So ammonia this fall is looking to be an expensive nutrient. And then, so the economics aren't really there to tell you, you want to use ammonia right now, but then one other factor that we're watching on what farmers are going to do this fall and how that's going to affect anhydrous consumption is it's really dry. And when it's really dry, it's more difficult to apply ammonia. You need some moisture to lock that nutrient into the ground so the ammonia doesn't volatilize. So we're expecting a little bit slower than normal ammonia season this fall. Could help ease some of the supply pressure this quarter. And then we're expecting a fall in nitrogen prices in the first quarter. So the question is, if ammonia is so expensive, why aren't we seeing urea prices start to spike and respond and move up as well? And the answer really lies in the Southern Hemisphere. Fertilizer pricing is really just a Northern Hemisphere versus a Southern Hemisphere game. Since we produce fertilizer, 365 days a year, but you only use it in a very short window. It's really important to know who's planting. And in the third quarter, what we would normally expect to see is Brazil and India would start to compete for tons. Well, Brazil over learned about supply availability coming out of Russia that they've pulled back on urea purchases, and we're seeing the same thing with India. India is the world's largest urea importer, and they've slowed their purchases as well. It's that strong dollar, high price, and that's going to help ease some of the price pressure on ammonia heading into the first quarter. China remains a wild card in the urea market. So on the left-hand side, I've got the spread between what the global market is in red versus what Chinese farmers are paying for urea in the blue. And there's a big spread between the two, and that's because China has an export ban. They're keeping all their fertilizer in country. Well, that's added to some supply length and lowered their prices. Now, what we're starting to see peak out of China is higher port inventory and exports. It's definitely some factor to watch heading into the fourth quarter, what China decides to do. But on a policy basis, it seems like you can export urea sort of almost if you're friendly with the port authorities. So on an economic basis, it makes sense for China to start exporting, but politically, we're not seeing big volumes of urea come into the fourth quarter. Okay, so our price outlook for nitrogen, steady with a 4Q winter upside. If we have a really cold winter, natural gas demand goes really high, we could see prices start to spike again. But I think at the retail level, the US market looks relatively balanced. We've seen a decline in both wholesale and retail nitrogen prices that matches each other, so we think the market there is balanced. Moving on to potash. A big change in the potash market here is that we're starting to see Belarus is finding more options to get their potash out to market. You know, Belarus, they ship about 12 million metric tons of potash annually. The market for potash is about 65 to 70 million metric tons. And, you know, potash is the nutrient that's most responsive to higher prices. In 08 and 09, when we saw potash top out over $900 a short ton, you know, demand for potash halved and prices fell by about half. We're expecting potash pricing to take a breather and continue to slow down in the fourth quarter. That's primarily because there's not a lot of demand for potash in the fourth quarter. You know, we do a little bit in the US. Brazil and India stop buying in the southern hemisphere, and everybody waits for potash consumption to pick up again in the first quarter with US and European planting. So typically you'll see prices slide into the fourth quarter. We're expecting more of that because farmers everywhere are pulling back. I mean, I know I'm throwing a lot of data and numbers out here at you, but basically, if you take away one thing, you know, farmers everywhere are pulling back on prices and, excuse me, on fertilizer. Year-to-date potash imports are down across the globe. You know, a similar story in our southern hemisphere neighbors to what we saw in urea. Brazil and India, they're pulling back significantly on their potash demand. Without them in the market, prices are gonna start to fall. Looking to what we have for North American potash inventory level is significantly above the 5-year average, and also last year, you know, we had a really delayed spring. Farmers pulled back on the pricey nutrient. Canada started to ramp up their production to take market share in Belarus's absence, and all of that combined to a really high ending inventory for potash. So we should see good availability for those that want to use potash this winter. Just briefly, I'm going to mention that BPC, which is Belarus, so they've been sanctioned. They're landlocked. Normally, their tons go out of Lithuania. Lithuania is part of the EU and said, no, you're sanctioned. You can't rail your tons out. Belarus is a low-cost producer. Potash prices are high. They're looking for alternatives, and they found one all the way north in Russia in Murmansk port. They shipped one vessel out of there to Brazil. So they're starting to increase their exports, but next year is going to be a really big problem. We expect that this year Belarus can export about 4 to 5 million tons. That's down about 50% from last year. Next year is going to be worse. We think they only can do about 2 to 3 million metric tons of potash. So that's going to support potash pricing on the low end. Russian trade is starting to normalize, so we're getting about the same amount of potash out of Russia as we did last year, despite Russian sanctions. Things got a little hairy. February and March, we had lower volumes, but Russian trade's picking back up again. So the next thing to watch for potash pricing is going to be what level China decides to buy at. They purchase potash on a 6 or 12 month potash contract. The last one was done at $5.90 for a 12-year basis. And we expect that potash pricing in the next Chinese contract is going to fall to about $5.50, which will set, we think, the floor for potash pricing in the first quarter. And so our outlook for potash pricing is soft. We've seen at the retail level that prices are only down 5% from the second quarter, but that's not the same softness that we've seen at the wholesale level, where potash pricing is off 17% at $700 a short ton. So there's a little extra room there for some softness in the retail market, if that's what you're looking at. And the next thing to watch is just going to be how much potash does China want to buy and at what price in the first quarter. Similar story on phosphate pricing. Phosphate demand is starting to slow globally. The big deal here is Brazil and India. I'm just a bit of a broken record, but if you know who's planting where, you can follow fertilizer pricing. And as India has bought a lot in the third quarter, they're going to pull back. They don't need it much in the fourth quarter. In their absence, we expect pricing to fall. Also, sulfur pricing and phos acid pricing has come off between 20 and 40% over the last quarter. That's going to lower the cost of production for phosphate. It's going to lead to some price softness there. China is the big wild card in the phosphate market. China also had an export ban on phosphate. That's a big deal because China is the marginal producer for phosphate, and they're about 1/3 of the export market. So when they stepped back, it had a big impact on phosphate, but we're starting to see a pickup in available supply at the ports for DAP and MAP for China. So when they return to the market, which is what they're starting to do, prices are going to fall. So soft outlook for phosphate pricing, just on the retail basis, we've seen prices come off 14% to $860. Now that's not, we've seen a sharper decline in phosphate pricing at the wholesale level. Prices are $795, down 25%. So there's more room to run on that price spread for softness at the retail level if you're looking out here at the fourth quarter. With that, I'm just going to stop and ask for any questions.
If you do have any questions, we do want you to put those in the chat or in the Q&A. You're welcome to put them anywhere. We will get Alexis asked as soon as you put those in there. I am sure that has given Mike some things to think about as well as he's getting ready to do his presentation. But if you do have any questions, please go ahead and put those in there. Mike, do you want to go ahead and get started? Go ahead and
pass me the ball. Yep, thank you. Right. See my slides okay, Christy?
Yes, you're good.
All right, thanks, Christy. What we're going to talk about today as I wrap up the meeting, I'm going to talk about harvest progress. Things are growing very good in the U.S. as far as getting crops out. About the only delays are up there in the Great Lakes area, but future harvest weather. Big question here, and Sterling alluded to this. Will the river flow increase soon? I don't think so. We've got more moisture in the forecast, but it's not looking good for getting those rivers flowing and getting those barges down to the Mississippi, down to New Orleans. And we're going to wrap up with a quick look at the October crop report and looking forward to the November report. We had a very late spring this year. Here in Illinois, we planted the crops 2 weeks later than normal. Up in North Dakota, they were close to a month behind. But despite those planting delays, corn and soybean harvest is well ahead of the 5-year average. And here's what the numbers look like. As of Sunday, we were 45% harvested on corn compared to the 40% 5-year average. And one thing as I look at yields and harvest progress in those states where yields aren't quite as good, the crop comes out pretty rapidly, and that really showed up. Kansas, South Dakota, Nebraska way ahead of normal. And again, they had a lot of corn that died early. But their corn crop is coming out pretty rapidly, which tells me bushels aren't there. The soybean harvest is even going better. As of Sunday, we are 63% cut compared to the 52% 5-year average. And looking at some of these numbers, it's basically Illinois, Mississippi River West, South Dakota, Iowa, Minnesota, Nebraska most ahead. And I think when these numbers are updated next week, the soybean harvest will be well over 80%. How were we able to catch up so rapidly? I know we did have the drought in the West. Basically from Kansas, Nebraska, South Dakota, that's where the crops died early. That was allowing those folks to catch up. But bottom line, it's been very dry, and that's showing up on our river systems. And looking at this morning's U.S. Drought Monitor, not much white on that map. Believe it or not, this is the most color the U.S. Drought Monitor has ever had since it's been originated. 82.23% of the nation is abnormally dry or drier. We broke the record last week, but the last time we were this dry, you have to go back to 2012, July 17th. So again, dry conditions, that's why this harvest is coming out so rapidly. And again, as all this is also impacting our river system. So kind of look at where it's so dry. Been dry here in the West for a long time. We're also getting some very dry weather. Sterling talked about where the Mississippi and the Ohio converge. Look how dry it is here also. And that matches up pretty rapidly with the watershed map we'll talk about here in a little bit. One other thing we're seeing an impact of the dry weather is winter wheat seeding. Been a lot of wheat around the U.S. that's been dusted in. We're real close to average as far as wheat seeding. We're 69% planted on Sunday compared to the 68% 5-year average. But emergence is delayed in many areas due to dry soils. It's showing up the worst in Kansas and Oklahoma. And here in Illinois, I've got some buddies who planted wheat 2-3 weeks ago, and it's coming up very erratically. So again, not only are we having trouble with wheat in dry soils, it's also coming up very erratically where we've had some rain. So that's going to be a little hindrance on yield. And we really want to get that wheat growing as soon as possible to build a little more height and a little more toughness going into the winter time. Nice harvest weather continues through Sunday. Look at that nice white area throughout most of the Midwest. No rain chances at all through Sunday morning. I think that's 6 a.m. time. So we're going to get a lot more crops out. About the only problem we've had trouble getting the combines rolling has been up here in the Great Lakes through parts of Wisconsin, Michigan, into northern Indiana, Ohio. So hopefully they can get a little bit more combining done before it rains again. What do I think about harvest progress for next Sunday? I think corn is going to be at least 60% plus. The only issue there, Brooks is and again, we talked about this earlier. Soybean harvest should be well over 80% by the numbers when they get updated here on Sunday and they re-reported on Monday. This map also kind of talks about that Mississippi River system. I've got 30-day percent of normal rainfall in areas where the Mississippi is the driest. And that's the biggest issues from what I've seen on the maps is from St. Louis, real dry around Memphis. In fact, record low levels at Memphis. We've also got very dry conditions along the Ohio. So again, looking at this map, the redder those colors are, that's the lower, the smaller percentage compared to normal. So those dark reds are only 0 to 10% of normal rainfall over the last 30 days, and that's really impacted us. And again, when you talk about the Mississippi, it drains, I think 80% of the U.S. is water. So not only is it dry down here where the Mississippi, Ohio flows, a lot of this area up here also drains into the Mississippi. It's been very dry in the Dakotas. Up here to this map, and a big chunk of the U.S. where we're draining into the Mississippi has been very dry here, not only the last 30 days, the last 60 days, the last 90 days. Last week, I think Sterling talked about the 4-week change. This is just a 1-week change. It got even drier along the Mississippi and Ohio rivers. We've got very dry conditions, southern Illinois, the Ohio River, very dry. And also we added some continuing moisture stress along the Mississippi, Arkansas, Louisiana areas. 7-day forecast does look a little bit better. This is my 7-day forecast over here from the WPC QPF, and it's showing some rains, but again, that's better than a white area or a donut hole for rain, but we're only talking a 1/2 inch to 3/4, maybe an inch of rain. And that map was showing upwards of 1.5 inches just a few days ago. So that is a blessing here. But again, as dry as outlook, trending above normal, but we dry off again on the 8 to 14. So we may get some short-term relief here over the next week to 10 days. But I don't see enough situation. We're going to get a lot of water into that river here rapidly. And this map shows that pretty well. What this map is the 0 to 10 centimeters or 0 to not quite 4 inches. That is soil moisture percentiles compared to normal. And again, looking at the Ohio River, the Illinois part of the Mississippi, southern Illinois, a little better situation. We're down here in Arkansas, maybe Tennessee, Mississippi, we can get a little bit of water into that river, but if we get an inch of rain in Iowa, the inch of rain is going to soak in. We get an inch of rain this weekend or early next week in southern Illinois, that rain's going to soak in, and it's also going to soak in along the Ohio. So again, I don't think we're going to see a lot of runoff, even if we do get some rain as dry as what the soils are. Another issue with the dry soils, and Alexis talked about this, very concerned about getting good feel for the ammonia. Especially in that western belt where they've got a bad crop, on-crop insurance levels, and do they really want to put a lot of ammonia down in some of those areas where it's customary when soils are this dry and the ammonia costs this much? I'm going to talk about ammonia seal. The ammonia normally goes down 6, 8, maybe 9 inches depending on the applicator. And again, I've got a little deeper soil profile map here. This is 0 to 40 centimeters, so that's 0 to not quite 16 inches where the ammonia is going down. And look how dry it is, not only here in northern and central Illinois where ammonia is customary. Ammonia is also customary in most of Iowa, southern Minnesota, parts of Nebraska. So very dry in that soil profile. So an inch of rain is going to help, but it's not going to fix that soil moisture deficit in the upper 14, 15 inches of soil. Another thing we have to watch with ammonia too, with it being this expensive. Last fall, most of my friends in Illinois were able to buy ammonia for $7.50 prepaid. With the prices that Alexis is talking about, you know, $11, $12, $13, $1,400. Do we really want to put ammonia into dry soil and then also have very warm soil temperatures? Here in Illinois, anyway, the recommendation is where ammonia is recommended. That's generally on the northern 2/3 of the state along the North Route 16. They want that soil temperature below 50 degrees. And one thing that Alexis didn't talk about, not only is ammonia expensive compared to urea, we also need to, at least agronomically, it's a good practice to put an inhibitor into that tank. So that's going to add even more expense to that ammonia. And one of my concerns is it was very cold this week. I'm getting ready to take a run here when the meeting's over here today. I think I'm going to be sweating here today. Soils are going to rapidly warm back up here over the next 6 to 10 days, and that's going to take us into early November. So 1, ammonia is expensive, 2, soils are dry, and 3, soils are warm, and I got to buy the inhibitor. Does it really make a lot of sense to be putting a lot of ammonia on this early? Maybe we're better off to get a little more rain and maybe wait a little bit closer to mid to later November when soils are cool. Just my thoughts on that topic today. A few more slides here before I wrap it up and get ready to turn it over to Christy to close our meeting. wanted to talk about the October crop report, and I wanted to give Sterling and Brooks a little pat on the back. Back in June, July, August, we were talking that U.S. corn crop was going to end up somewhere in the lower 170s, and as a team, I think we are right on there today. What about the October crop report? I think as we saw by harvest progress and what I'm hearing on social media, the Western corn and soybean crops continue to shrink. Not only is an issue on not getting the yield, that crop also died early. Crop I've ever seen. We'll have to see how the government puts a final number to it. But here in Illinois, we had the dry June, had very little water damage, got some very timely rains. We didn't have a lot of tar spot. We actually had a Super Bowl or a home run type of year here in Illinois anyway. I'm going to have a statewide breakout. And again, it goes back to our talking point with the Edge group since last summer. Western areas were in trouble, and most of the states that had the big decreases from September to October were in the West. South Dakota down another 6%, Kansas down almost 6%. Sterling's home state of Nebraska down 2.3%, Texas down. So again, that Western area down. And about the only state that's trending up is Illinois. We're at a record 210 now. I think that number's a little bit low. So again, from September to October, not a big move here nationally. We dropped 0.6 of a bushel, but the Western crop continues to get smaller. Eastern crop, Illinois especially, gets bigger. And looking at that mapping and trend a little bit lower here in November, but not much, I don't think. Kind of the same story on soybeans. This one was a surprise. I was one of the first ones talking around a 50.5, 50.6 from August on. I just thought we didn't plant the beans early enough. We had too much dry weather. And I actually thought we'd go up a little bit in November, and I was wrong. We actually dropped to a 49.8. That surprised me. That's a drop of 0.7 of a bushel. And we're seeing kind of the same thing. The poor bean yield in the West. Kansas dropped all the way down to 28, dropped 12.5%. Although Nebraska, I'm going to say this right today, they're 1/3 irrigated, not underwater, but they're 1/3 irrigated, and they did drop all the way down to 49 bushels an acre. So thinking about a state like Nebraska, 1/3 underwater, we have a yield of 49. So again, the same trend on soybeans. This is kind of Sterling's area here. I really don't know how much lower we could drop these bean yields and have any beans left in the pipeline. So again, that's where the bean yield shook out. Looking ahead to November, kind of my thoughts are, will the over dry harvest moistures contribute to a reduction in yields per acre in November? Whenever you take soybeans out 8-9%, you're giving up some bushels there. Whenever those beans go into the bins or the bunkers that dry, it seems like there's always less bushels when you take them out. The big question is, as you watch the November report, is what's going on in Iowa. Anybody remember the fall of last year? Everybody kept talking about how good these Iowa crops, they were better than expected despite the dry weather. We're really not hearing that from Iowa this year. It seems like the crops are very good in northeast Iowa, been pretty poor in parts of the southern part of the state. So I don't think Iowa's better than expected. I think the dry weather and more heat this year hurt them. So will Iowa remain stable at 258? Still a very good crop for as dry as they were. And again, we also need to watch Illinois. In my opinion, Illinois is at least 215. It could be even higher than that. And although we planted the beans late here in Illinois, we're not getting as many 80s and 90s this year, but boy, there's been a lot of 70 bushel beans in Illinois. So again, I don't expect much change in November. If I had to put a number to it today, I think corn could potentially drop a couple more tenths. And again, I think soybeans should drop a couple more tenths, but can they really do that and still have any beans left on the balance sheet? Thanks for your time and attention here today. Those are some pictures from the farm. That's the puppy on the pumpkin patch. Beautiful view overlooking some of that rolling southern McLean County dirt that I grew up on. And I'm looking forward to my own personal trip down to the river system. That's myself and a nice rainbow trout that we took last Thanksgiving area down in the White River in Arkansas. And we're heading back, my son, my wife, the dog, and I, here in mid-November. I'm really looking forward to our White River 5K. I know Sterling and Christy signed up for that. I'm looking forward to having the opportunity to maybe be able to outrace them down in Arkansas coming up. Thanks for your time and attention here today, and I'll turn her back over to Christy to wrap things up.
Yes, well, I believe Sterling and I signed on to just kind of cheer you on, Mike. I'm pretty sure I think Sterling's gonna wear his cone hat or his
And I'm
corn
gonna wear
hat.
my foam corn hat, yeah, which by the way, it's still on sale on eBay for $10,000. I haven't gotten any bids, but it is out there.
But
Well, you guys have got your work cut out for you. Beat my son here at the race on Sunday, 22-24 to 22-26, and he used to be a sub 5-minute miler. So you guys have got your work cut out for you, but you do have a month to train yet. So you'll get it ready.
You can give me a lifetime to train. There's an old joke that you can't teach speed, and I am the living embodiment of that. I have all the God-given speed of a mailbox.
Yeah, but you were a very intelligent guy who called the stock market very well too, Sterling. So you've got your own. So
I try.
oh, no, we have had some wonderful information today, and honestly, it's just been amazing. So we do want to thank you. Thank you all for joining us today. We have recorded today's webinar and it will be available in an upcoming DMO. If you are not receiving our daily emails, be sure to send us an email to marketinginfo@sompointernational.com and sign up today. That has been put in the chat. So be sure to look there and make sure you sign up. We do want to thank you, Alexis, for sharing your expertise with us today. I mean, that was just some amazing information. So thank you. And as always, Sterling and Mike, you guys just always just bring the best. So we thank you. If you have any questions, please share those with us at marketinginfo@sompointernational.com, and we will respond to those as soon as possible. Do want to remind you that we do have a couple upcoming meetings. The WASD will be on November 9th. I'm not sure, Sterling, what kind of information should we be looking for in that WASD?
The first thing we're going to be worried about are going to be exports and seeing if the USDA makes any adjustments to that. That's the first thing. I think we'll have a pretty good grasp on yields, but again, we're going to have surprises, particularly look for soybean yields. If we have more trouble out here, I don't know if Illinois can beat, Illinois' strength can beat Nebraska's weakness, which, by the way, doesn't Illinois play Nebraska this weekend?
well, I'm not sure, Sterling. Yeah, I don't know.
I think they do, and that I'm sure that'll be another delightful moment for the Nebraska football program. But those would be the two biggest things that I would look at. And I think really we need to start paying attention to South America. We need to start thinking about, how their yields are going to look. And again, if we see fertilizer use being sluggish, we can again expect, a lot of yield variation. It's not like we're going, full boat, full steam like we did in 2018 or 2019.
Okay. Wow. And then, of course, we'll wrap all that up on November 17th with our monthly marketing meeting. We might have some more harvest information, you think, Mike? Maybe what's going on around the country. So be sure to look for those links in our newsletters. And like I said, if you're not getting those, make sure you sign up at marketinginfo@sompointernational.com. So again, thank you again. We did get a comment that said it was a great webinar. So thank you for that comment. We do appreciate it. We will talk to you soon. You all have a great day.
Thank you.
Thank you.
Thank you.